I remember when I was in college and I was learning about the mathematics underlying financial investments. I found the examples to be incredibly alienating because I'm sitting there and the teacher is talking to us about investing $10,000 at an interest rate of 5%. And I'm thinking to myself, first of all, where the heck am I going to get $10,000? And second of all, where the heck am I going to get an interest rate of 5%? At that time, I did have a checking account and a savings account available to me at my local credit union, right? But I was getting an interest rate of something like less than 1%. I think it was like 0.1 or 0.2%. So the idea of a 5% interest rate was just a fantasy to me at that time. But it's really strange because, I finished my undergraduate degree, I finished my graduate degree, I got the job that I wanted that pays well, and all of a sudden I'm sitting there at like age 25, basically in that position of having $10,000 sitting idle in my checking account and just trying to figure out what I should do with it. What's a financially responsible way to store that extra money? And that's what we'll be talking about a little bit today. And I totally understand if you're still early in your career, early in your life, and it's hard for you to imagine having a lot of money just sitting around and you're trying to figure out what to do with it. Your day will come. Maybe it's 5 or 10 years from now, but I really expect and hope that one day you're going to have to think about this stuff and do some research about investment, and I just want to get started opening your mind to some of the ideas. Alright, so you've got some money and you want to decide where it should go. You can store it in your checking account, but if you store it in your checking account, you're not going to earn very much interest at all. And over the course of time, this money that you have earned and saved is going to have less buying power because of inflation. We all know the story where mom comes in and talks to us about how she purchased a brand new car for $500 back in 1962, and that same car would be worth $40,000 or $50,000 today. So every bit of money that we put into our account over time is going to have less and less buying power because things are getting more expensive. So the question is there a way for us to store our money so that at least we have the same amount of buying power in 2040 as we have now? So let's compare a couple of different investments using what we have talked about, exponential functions up to this point. If you invest your money in some account, in some real estate, and something like that, you can represent the value of your investment using an exponential function. We use the y value to tell you how much your investment is worth, and x represents the number of years that have passed since you put that money into the investment. Now, when we talk about exponential functions, they always have an a and they always have a b. So the value of a, when you're dealing with investments, is equal to your initial investment, the amount of money that you first put into this account. And the value of b is given by a formula. You take the number 1, and then you add something called the APY. Now, the APY is something that you are told by the bank or by your investment brokerage when you're going to open up an account. So, for example, I've just gone out to our local credit union, and here are some rates, some interest rates that are being described for something called a certificate of deposit, which is a long-term investment. So it says if you invest at a balance of $10,000, your investment will earn an annual percentage yield, an APY. If you invested for at least 60 months or 5 years, you'll earn an APY of 0.9%. So this is the bank's way of describing to you how much interest you're going to earn on your investment. The value of the APY tells you how much interest your investment earns by the end of each and every year. So if you're thinking about making an investment, you have the amount that you intend to invest initially, that's the A value. The bank is going to tell you the APY for the account. And so then we have the formula, value of investment is equal to take the initial investment, the amount that you invest at the start, that you put into the account, and then multiply that by 1 plus the APY to the power x. X represents the number of years that have passed. So let me put that in. Here, this is number of years. And you can predict how much your investment will be worth at the end of a certain period of time. Now, when you're just getting started and you don't have a lot of money to work with and you need to get access to that money right away, you're probably going to have most of your money stored in a regular checking account. And unfortunately, because the money in a checking account is so easy to access, the bank is not going to give you a lot of interest for that. So the typical APY for a checking account is extremely small. For example, I think that mine, at the best, my checking account has been 0.1%. I think it's actually much smaller than that now with the economic effects of the coronavirus. So let's just do a quick example. Suppose that you invest $1,000 in a checking account that has an APY of 0.1%. How much will the investment be worth in 5 years? So our initial investment is equal to 1,000, and that's the A value. Our annual percent yield is equal to 0.1%, or if you write that as a decimal, 0.001. And so our base can be found by taking the number 1 and adding the APY. So the base is equal to 1.001. And finally, the number of years. The number of years, we're looking at 5 years for our investment. So let's go ahead and find the value by taking 1,000, the initial investment, multiplying it by 1.001, that's the base, to the power 5. Okay, now once again, I don't have my actual TR-84 with me now, so I'm just going to use the scientific calculator. Let's start in PEMDAS by going 1.001 to the power 5. And let's multiply that by 1,000. And we get a final value of $1,005.01. Which is not great at all, because in 5 years, the cost of something, which was originally $1,000, is probably going to be closer to $1,100 in 5 years. So the buying power of your $1,000 has gone way down, and it's essentially been sitting in that checking account just rotting and decaying away because it can buy so much less now than it could 5 years ago. Now, this is not an advertisement to spend all your money right away. That's not what I am saying. What I'm saying is that when the time comes that you have money beyond what you need to cover your expenses, you have to look into other options and other ways for saving your money. Now, the checking account earns a really low APY. Another option is a savings account, but savings account, again, you're going to get a very small amount of interest for that. Typically, your APY on a savings account is still less than 1%. And if you're trying to keep your buying power, so that it stays the same, or you can even buy more with your money over time, you're looking for an APY which is above 3%. So your first sort of viable option in terms of storing your money long term is something called a certificate of deposit. Now, a certificate of deposit can be acquired through your local bank or credit union, just like we saw those certificates through Alaska USA Federal Credit Union online just a couple of minutes ago. Now, certificates of deposits do come with a lot of benefits, but one of the major downsides of a certificate of deposit is that you essentially have to pledge your money to the bank and promise to leave it in the account without withdrawing it for a long period of time. So the money is locked in the account for a long time. How long a time? Well, that's sort of your choice. The longer that you promise your money to the bank, the larger amount of interest that they will give you. So if you promise not to withdraw it for 2 months, you'll probably get an APY that's only slightly better than what you would get from a savings account. If you promise the bank that you will leave the money in there for 5 years, you will get a much better APY that is somewhere between 1 and 3% typically. Another downside of certificates of deposit is that the APY tends to be low when the economy is doing poorly. When the economy is doing poorly, the government is trying to incentivize people to spend money and get that economy rolling again. So they're going to do whatever it takes to try and get people to keep money out of savings accounts and out of certificates. So when the economy is poor, you will typically see much lower interest rates on certificates of deposit. So for example, we just went out to Alaska USA, and the 5-year certificate had an APY of 0.9% right now. And in February, right before this whole pandemic started, that APY was 2.9%. So the APY has gone down 2% almost instantaneously because of the coronavirus. So there are two major downsides to certificate of deposit to counterbalance the fact that you typically have a higher APY. So let's do a quick example of a calculation. Suppose that the economy is doing well and we invest $1,000 into a certificate that has an APY of 3%. How much will the investment be worth in 5 years? So we still have our initial investment, which is A equals 1,000. We have our APY of 3%, which can be written as 0.03 as a decimal number, which means that our base for this example is 1.0.03 or 1.03. And once again, the number of years that we are considering is going to be 5 years. So the value in 5 years is equal to 1,000 times the base to the power of 5 for the number of years. And so let's see what the calculator has to say about that. It's clear. 1.03 to the power of 5 multiplied by 1,000. So in this case, our investment is now worth $1,159.27. So we seem to be beating out inflation at this point. $11,059.27. The big price, though, is that you have to be somewhat lucky with your timing in terms of when you create this certificate, and these $1,000 will not be accessible to you at all in 5 years. Okay, now this is for things like passive income where your money is making money for you, and the buying power of your investment is actually increasing over time. So the longer you keep your money in the investment, the more stuff you can buy when you finally withdraw it from the investment. And when we're talking about stuff like that, we are definitely talking about investing in the stock market. Now, I remember when I was first learning about stock market investment, I had this crazy image in my head of like trading places where you have these guys in suits in offices with leather chairs who are flipping stuff and buying at 0 cents and selling at 7 cents and all kinds of stuff. But the reality is that the stock market is totally accessible to just any regular person. Here I am, just a complete casual, but I'm still able to invest in the stock market. And it's a lot easier and more straightforward than I thought that it was. It's just that because I didn't grow up in a household which had a lot of money, it wasn't something that I was exposed to, this idea of investing in the stock market. So it was something that was kind of freaky and foreign and strange, and I was scared of it for a long time, but it's much, much simpler than you think. Now, stock market investment. If you're a filthy casual like I am, your way of investing in the stock market will be through a brokerage. And the real popular ones right now are Fidelity and Vanguard. Not to debate about which one of these two is better. You'll have to do your own research once you're ready. Now, if you are a casual, you're probably going to invest in the stock market using something called an index fund. And this is for casuals. This is for us who aren't wearing suits and sitting in the leather chairs. Use an index fund. Now, when you get an index fund, what you are doing is you are buying a teensy-weensy piece of like 500 different American companies. Now, the benefit of buying a very small portion of equity in hundreds of companies is that if any one company starts to do poorly, maybe they make some bad business decisions and they become bankrupt, it represents such a small fraction of your investment that if any one company does badly, your overall investment really isn't hit that hard. Another benefit of the index fund is that the value of the money in the index fund remains pretty stable over time. So this goes up in value at a fairly stable rate. If there's a nationwide economic crash or recession like we saw in 2008 and like we saw in March of 2020, okay, your investment is going to temporarily look like it's worth less. But over the course of a long period of time, if you put your money in an index fund and just leave it there for like 30 years, you are not going to notice any crashes or recessions or depressions or bumps that have happened. So crashes and recessions aren't that noticeable over long periods of time. So the key with an index fund is just to stick your money in there, close your eyes, and just leave it alone for decades, for as long as you can stand it. index funds do best when you're not messing with them. So they're the best if you're busy and hands-off and casual, and you don't want to mess around with the stock market too much. You just want to get a good return on your investment. So suppose that we invest $1,000 in an index fund, is what this should say. With an APY of 7%. This is actually very typical. This is actually a somewhat conservative estimate for an index fund. I am currently invested through Fidelity in their total market index fund through the S&P 500. And the APY there is actually 13% at the moment. So this 7% is a low estimate of the index fund's actual interest rate. Okay. So how much would that investment be worth in 5 years? So in the example problem, we now have 1,000, 1 plus 0.7%, so here we have 7, and then raise that to the power 5. And in the calculator we have 1.07 power 5 multiplied by 100. So in this case, just investing conservatively in an index fund, at the end of 5 years, our investment is worth $1,402.55. So in this case, we are actually beating inflation, and the longer we keep our investment in the account, the better for us. The longer we keep it in the account, the more interest that we have just earned, and we can do whatever we like with. And so this is the big takeaway. Once you have gotten your career job and you're earning all the money, you really, really, really need to do some research into investing. In particular, how a regular person invests in the stock market. This kind of process is essential for setting yourself up for retirement. Not just retirement at 60 or 65, but potentially if you're really clever with your money and you're really frugal when you're young, you can retire at 45, at 50 years old, and just live off the interest that you're earning and use that to pay your expenses. So it's really worth looking into. Please don't wait as long as I did. I waited too long. As soon as you have, I would say as soon as you have even $5,000 saved up, the time has come to learn about investing.